In this video, we're going to talk about a little bit more detail with respect to creating investments and portfolios in particular. So what is a portfolio? Essentially, it's just a collection of assets or investments that are created or is created to achieve some type of a goal. So portfolios can be growth oriented, where they're looking for long-term price appreciation, or they can be income oriented, where they can be designed to produce some type of current cash flow for current consumption. Or they could be combinations of both. So the ultimate goal of portfolios is to create something called an efficient portfolio. An efficient portfolio is one that gives the highest rates of returns for a given level of risk. What this requires, though, is we have to look at several alternatives and then combinations of alternatives in order to find that best combination of risk and return. So given the choice between two equally risky investments, an investor is going to choose the one with the highest potential return. So in other words, when you're choosing assets, you will choose that asset. If everything else is similar, you choose the one with the highest return. And likewise, if you have two assets that have very similar or identical returns, you want to choose that investment that has the least amount of risk. This is essentially allowing us to create a set of opportunities that we would refer to or define as being efficient portfolios. So a portfolio return is calculated as a weighted average of the returns of the assets in the portfolio. The standard deviation, though, is a little bit more complicated. It certainly contains the risks from the individual assets, but those assets, those individual investments, all are related to each other. The statistic that we'll talk about is something called correlation. So the standard deviation is a function of the assets' weights, their standard deviations, and then this relationship that they have with each other. So let's talk about how you find the rate of return on a portfolio. Here we have, this is the worksheet. It's called the Portfolio Beta and Return Worksheet. And we have two assets, A and B, 35,000 in A, 15,000 in B. So we've invested $50,000 in these two assets. And what we'll find, or what we've been able to find from this then, is that 70% of our money is invested in A and 30% is invested in B. Now the rates of returns that we have for these assets, 8.75 8.75 for A and 3.75 for B. So our worksheet, Portfolio Beta and Returns, you input the dollar amounts of the assets. Now you could also plug in the weights. Either way, you'll end up getting a calculation for weights based on the numbers, obviously, that are input here. The rates of return are input under the return column. Later, we'll talk about beta, and beta goes under, obviously, the beta column. So for this particular portfolio, you would expect to earn around 7.25% is what you would earn on this portfolio. Now, correlation is a statistical measure of the relationship between two series of numbers. It positively related means they move together. Negatively related means they move opposite of each other. And of course, if they're uncorrelated, they have no relationship with each other. Now, statistically, we don't really need to know the formula here, but betas can have correlation can have a maximum of +1 or a minimum of -1. We are able to calculate correlation, though. There's a spreadsheet that talks about calculating correlation. And this one you would input the prices, and that would calculate the returns on the investment. So here for asset A, here are the returns we have. The average rate of return is 8.43, and the standard deviation is 12.4. On the other side here for asset B, again, we have another asset. Here are the prices, and here are the returns on these particular periods. 7.94 and a standard deviation of 14.21. And the correlation between these two assets is 0.95. So 0.95 is obviously positive. So these two things will seem to act alike. And it's a very strong relationship. So when one moves, the other one is going to tend to move the same direction and in the same magnitude. As a general rule, the lower the correlation, the greater the risk reduction that you get when you combine those assets in a portfolio. So assets with a +1 correlation will receive no reduction of risk. There's no correlation between those two assets. And again, as the correlation declines from +1, it'll eliminate some risk. At 0, it eliminates even more risk. And at -1, correlation could actually eliminate all risk. So the assets that are less than positively correlated tend to offset each other a little bit. It's an averaging process, and that in the end helps us to reduce the overall risk in a portfolio. So here we have Celgene, I'm really not sure what that company does, and IBM, and these are two companies, obviously, and we have a relationship here. This is the portfolio return, and this line represents then the risk and return of the combinations of IBM and Celgene. So every point on here represents the risk and return. So right around here is 15% the return, and that has around a 17% or so standard deviation. Now, one of the things you need to note here is when we were talking about efficient portfolios, right? So let's think, would you rather buy IBM or would you rather buy this investment right above it here? Well, if you remember our rule, it said if two assets have identical risk, you want to choose the one with the higher return. So that means all of the portfolios that are on this underside of this curve, these are not efficient portfolios. There's something better that you can buy. Likewise, if you kind of think here, if there was assets in here, right, you want to be as far over here as you can, which would give us the least amount of risk at a certain rate of return. Now, how this curve is created, it's created by the correlations between the assets. The straight line represents a correlation of +1. And again, when you combine two assets, you won't get any reduction in risk if the correlation is perfectly positive. But as the correlation declines from +1, you see that we get the same combinations of assets, but the return changes, and we get this bullet-shaped kind of curve. And at -1, we can actually find a combination of these risky things that would provide us with a risk-free asset. And we'll talk about this in other videos and possibly in other courses. But the point here is that correlation is what creates the possibilities of diversification. Now, if you consider this last example where we're talking about Celgene and IBM, let's assume that both of those are United States or domestic companies. What happens when we add international assets? Well, what we find is that international economies are not positively correlated, certainly not perfectly positively correlated with United States markets. So since they're not perfectly positively correlated, when you combine international securities with domestic securities, you get a reduction of risk. And of course, if you can diversify across many stock markets around the world, rather than just a couple, there's many stock markets. So the globalization of our economy has given us these correlations that tend to be rising a little bit. The global economy is coming together, if you will. So we are losing some of the correlation that's historically been possible internationally, but we still do get some diversification. And as they say here, they did a study between 1984 and 1994. And basically that's a look, if you have a portfolio that's 70% Standard & Poor's and 30% East Asia, Far East, that would reduce risk by about 5% and increase return 7% over a portfolio that was 100% invested in the S&P 500. So not only do we get reductions of risk, we also get the potentials of increases in income when we combine international securities. So the advantages of international diversification is we get more choices, potentially higher rates of returns, and of course we get reductions of risk. However, you never get good stuff without getting some bad stuff. So the disadvantages, we have currency exchange risk. It's a little less convenient sometimes than buying United States stocks. It can be more expensive to invest, certainly more expensive to do research. And finally, in the end, we do know it is a little riskier than investing in the United States. Not necessarily because of the companies, but because of politics, because of the differences in the economies of countries. So how can we diversify internationally? We can do what's referred to as direct investment abroad. We can purchase foreign currency investments, right? Those foreign currency investments is going to bring the international flavor to our portfolio. So we can, it's a little less convenient, a lot more expensive. And again, we've been talking about this is certainly riskier than investing in the United States. In addition, we can invest in stocks or bonds of foreign companies. So you can buy just the currency and get that international diversification, or you can buy securities. Yankee bonds are what are referred to as it's a bond that's issued in the United States, but it's issued by a foreign entity. And an American depository share is a receipt, if you will, that represents a stock that's held in a vault of a bank. So the other, quite frankly, I think the more efficient and certainly least costly of all the methods is to invest in what are referred to as international mutual funds. And we'll talk about mutual funds in general in detail so that you'll understand the importance and the simplicity of that form of diversification. So what about a portfolio? Frequently people say, hey, why don't you just buy United States companies that have based in multinational corporations? So this is a United States company, but it has offices and factories all over the world. Well, a portfolio of international multinationals is more diversified than a portfolio of wholly diversified domestic firms, but you really don't get the full benefit. And the reason for this is the United States market in stocks is the biggest market in the world. So by definition, you're going to have a very heavy weighting towards United States stocks. So to fully realize the benefits of international diversification, we really should be looking for companies that are actually located outside of the United States and not have a domestic influence. The one really big downside, we've mentioned this a couple of times, is the cost. So investment advisors suggest, you should have an allocation of foreign investments of 20 to 30%. 2/3 of that should be in established foreign markets and another third in emerging markets. Now the transactions cost on these are very high. You have to pay advisors, right? We have to pay somebody to analyze the companies. And since they're not domestic, since they're in international currencies, since they're in a country that probably has a different basis of accounting, it really takes somebody with a special eye to be able to analyze these companies, and that can be very expensive. International mutual funds and ADSs allow you to obtain diversification with relatively low cost. The convenience is usually much less or much higher convenience. Transactions are almost in dollars. And of course, since they're sold in the United States, you have the protection of United States securities laws. So that's the end of the first part of modern portfolio concepts.